October 24th, 1929, Black Tuesday, the day the stock market didn't just fall, it obliterated. $9 billion of wealth vanished in a single trading session. That's equivalent to 140 billion today. Gone, wiped out, destroyed. But here's what they don't tell you in the history books. While millions of Americans watched their life savings evaporate, while families lost everything they'd worked decades to build, while the country plunged into the Great Depression, a small group of men made fortunes. Not just survived, thrived. Jesse Livermore walked away with over $100 million. That's 1.5 billion in today's money. From one crash. Warren Buffett did the same thing in 2008. While the global financial system collapsed, while banks failed, while ordinary investors lost $7 trillion, Buffett made $10 billion. Ray Dalio saw it coming in 2000, the dot-com bubble. He positioned his fund perfectly, made billions while the Nasdaq fell 78%. These men didn't get lucky. They followed a playbook, the same 3 moves, executed before every major crash for the last century. And right now, in 2025, the exact same warning signs are flashing. The same patterns that preceded 1929, 1987, and 2008 are happening again. And the billionaires, they're making the exact same 3 moves. The market is at all-time highs. Valuations are stretched beyond anything we've seen since the dot-com peak. Ray Dalio just announced we're 80% of the way to full bubble conditions. Jamie Dimon, CEO of the largest bank in America, is warning of a crash within 6 months to 2 years. The Benner chart, which has accurately predicted every major crash for 150 years, is signaling danger for 2025. And while retail investors are buying the dip, while financial media tells you everything is fine, the smart money is quietly executing the same strategy that's worked for generations. They're not panicking, they're positioning, because crashes don't destroy wealth, they transfer it. From the unprepared to the prepared, from the emotional to the strategic, from the masses to the billionaires who understand the game. This isn't about predicting when the crash will happen. Nobody knows that. This is about understanding what happens when it does, and more importantly, what you can do right now to position yourself like the billionaires instead of like the victims. Because the next crash is coming, it always does, and when it arrives, you can either watch your wealth disappear or you can be one of the few who profits from the chaos. Let me show you exactly how they do it. The 3 moves that separate the winners from the losers, the strategies that have worked through every crash, every recession, every financial crisis for the past century. And why 2025 might be your last chance to get positioned before it happens again. Move number 1, strategic cash accumulation. This sounds simple. It's not. Because holding cash when everything is going up feels like the stupidest thing you can do. When stocks are hitting new highs every week, when your neighbors are bragging about their crypto gains, when financial advisors are telling you cash is trash, the billionaires are doing something that looks insane. They're hoarding cash. Massive amounts of it. More cash than they've held since 2001. More than 2008. We're talking about $1.7 trillion in cash held by the world's billionaires right now. That's not a typo. 1.7 trillion sitting in cash while everyone else is fully invested. Why? Because they understand something most people don't. Cash isn't just money, it's ammunition. It's opportunity. It's the weapon you use when everyone else is forced to sell. Think about it this way. When the market crashes, what happens? People panic. They need liquidity. They're forced to sell their stocks, their bonds, their real estate at whatever price they can get. Fire sale prices. And who's buying? The people with cash. The people who prepared. The billionaires who looked stupid for months or even years suddenly look like geniuses. Here's the specific data that should terrify you. Wealthy investors, people with over $1 million in investable assets, now hold 24% of their portfolios in cash. A year ago, it was 14%. That's a 70% increase in cash holdings in just 12 months. They're not doing this because they're scared. They're doing this because they're smart, they see what's coming, and they're positioning for the opportunity of a lifetime. But it's not just about having cash. It's about having the right kind of cash in the right places. The billionaires aren't stuffing money under mattresses. They're using sophisticated cash management strategies, short-term treasury bills that can be liquidated instantly, money market funds that provide liquidity while earning some return, foreign currency deposits that protect against dollar devaluation. They're not just holding cash. They're weaponizing it. The average person thinks holding cash during a bull market is losing money. The billionaire thinks holding cash during a bull market is buying insurance for the crash. Because when that crash comes, and everyone else is desperate for liquidity, cash becomes the most valuable asset in the world, more valuable than stocks, more valuable than bonds, more valuable than real estate, because cash is what everyone needs and nobody has. Jesse Livermore understood this in 1929. While everyone else was buying stocks on margin, borrowing money to buy more stocks, Livermore was building a massive cash position. When the crash came, he had the ammunition to short the market while everyone else was getting destroyed. Warren Buffett did the same thing before 2008. Berkshire Hathaway was sitting on billions in cash that everyone thought was stupid. Until the crash came, then Buffett became the lender of last resort, making deals that generated $10 billion in profits while everyone else was losing their shirts. This is move number 1. Build cash, lots of it. More than feels comfortable, more than your financial advisor recommends, more than conventional wisdom suggests. Because conventional wisdom is what keeps you poor while the billionaires get richer. Move number 2. Strategic diversification into safe haven assets. This isn't your typical diversification. This isn't spreading your money across different stocks or sectors. This is moving money into assets that perform well when everything else is falling apart. Gold, government bonds, alternative investments that have negative correlation to traditional markets. The billionaires know that during a crash, normal diversification fails. When panic sets in, all stocks fall together, all bonds fall together, all real estate falls together. Correlation goes to 1. Everything moves in the same direction. Down, but certain assets move in the opposite direction. Gold has been the ultimate safe haven for 5,000 years. During the 1929 crash, while stocks fell 89%, gold held its value. During the 2008 crisis, while the S&P 500 fell 57%, gold rose 25%. During market panics, people flee to gold. Always have. Always will. The billionaires know this. Ray Dalio recommends 15% of every portfolio in gold. Robert Kiyosaki is hoarding gold and silver in anticipation of the next crash. They're not buying gold because they think it's going up. They're buying gold because they know everything else is going down. Government bonds provide similar protection. During the 1929 crash, while stocks were getting annihilated, US Treasury bonds were safe havens. People fleeing the stock market poured money into bonds. Prices rose while everything else fell. The same thing happened in 2008. The same thing happens in every crisis. When fear takes over, people want safety. Government bonds represent the ultimate safety for most investors, but the really sophisticated billionaires go beyond gold and bonds. They invest in alternative assets that most people have never heard of. Infrastructure debt that pays fixed returns regardless of market conditions. Farmland that produces food regardless of stock prices. Energy assets that generate cash flow in any economic environment. These investments provide what the billionaires call asymmetric returns. Limited downside, unlimited upside. Protection during crashes, profits during recoveries. The key is positioning before the crash happens. Once panic sets in, these safe haven assets become expensive. Gold spikes, bond yields fall, alternative investments get bid up. The time to buy protection is when nobody wants it, when it looks stupid, when conventional wisdom says you're wasting your money. That's exactly when the billionaires are loading up. This diversification strategy serves 2 purposes. First, it protects existing wealth from getting destroyed in the crash. Second, it provides stability that allows the billionaires to remain calm and think clearly when everyone else is panicking. While retail investors are watching their portfolios implode and making emotional decisions, the billionaires are sitting on assets that are holding their value or even rising. This psychological advantage is enormous. It allows them to execute move number 3 with precision and confidence. Move number 3, contrarian investment strategies and opportunistic positioning. This is where the billionaires separate themselves from everyone else. While the masses are running for the exits, while panic selling drives prices to absurd lows, while fear dominates every decision, the billionaires are doing the opposite. They're buying, aggressively, strategically, with surgical precision. This move requires something most people don't have. Ice-cold nerves. The ability to act when every instinct screams retreat. The discipline to buy when everyone else is selling. The conviction to bet big when uncertainty is at its peak. Because here's what the billionaires understand that most people don't. Market crashes create the greatest buying opportunities in history. Not sometimes, always. Warren Buffett's famous quote captures this perfectly. Be fearful when others are greedy and be greedy when others are fearful. Sounds simple. In practice, it's the hardest thing you'll ever do. Because when markets are crashing, when headlines are screaming financial apocalypse, when your neighbors are losing their homes, when retirement accounts are evaporating, buying feels like financial suicide. Every fiber of your being tells you to sell, to run, to hide. The billionaires do exactly the opposite. They wade into the carnage with their cash ammunition and their psychological armor. They buy the best companies at fire sale prices. They negotiate deals that would be impossible during normal times. They secure terms and returns that generate wealth for decades. While everyone else is focused on protecting what they have left, the billionaires are focused on acquiring what everyone else is forced to sell. Let me show you exactly how this works. During the 2008 financial crisis, when banks were collapsing and the global financial system was on the brink of total meltdown, Warren Buffett made one of the greatest investments in history. He invested $5 billion in Goldman Sachs, not at market prices, at preferential terms that guaranteed him a 10% annual dividend plus warrants to buy more shares at below market prices. Goldman was desperate for capital. Buffett had the cash. The result was a deal that generated over $3 billion in profits for Berkshire Hathaway in just 3 years. That's not luck. That's strategy. That's what happens when you position yourself with cash and safe haven assets before the crash, then deploy that capital when everyone else is in panic mode. Buffett didn't just buy Goldman Sachs stock. He got preferred shares with guaranteed dividends that were higher than treasury bonds. He got warrants that allowed him to buy more shares at fixed prices. He got terms that no investor could get during normal market conditions. Because normal market conditions don't exist during crashes. Jesse Livermore did the same thing in 1929, but from the opposite direction. While everyone else was buying the dip and getting destroyed, Livermore was shorting the market. He made over $100 million by betting against stocks that everyone thought would recover. He understood that crashes don't happen slowly. They accelerate. They feed on themselves. Fear creates more fear. Selling creates more selling. Prices fall further than anyone thinks possible. Livermore's strategy wasn't just about shorting stocks. It was about understanding market psychology. He recognized that most people would hold on to losing positions too long, that they would average down into falling stocks, that they would refuse to accept reality until it was too late. So he positioned himself to profit from their mistakes. While they were buying the dip, he was shorting the rally. While they were hoping for recovery, he was betting on disaster. But the most sophisticated billionaire strategy isn't just buying or shorting during crashes, it's buying the right assets at the right time with the right structure. They're not just buying stocks, they're buying distressed debt. They're acquiring real estate from forced sellers. They're purchasing entire companies at fractions of their intrinsic value. They're making investments that would take decades to become available under normal circumstances. This is where the cash from move 1 and the stability from move 2 become critical. Because these opportunities require massive capital deployment at exactly the moment when capital is most scarce. Banks aren't lending, investors are fleeing, credit markets are frozen. The only players with the ability to act are the ones who prepared in advance, the billionaires who built cash positions and protected their wealth with safe haven assets. Ray Dalio demonstrated this perfectly during the dot-com crash. His fund Bridgewater made billions by correctly identifying the bubble and positioning for its collapse. But they didn't just short technology stocks. They bought government bonds that rallied as investors fled risky assets. They bought international assets that were uncorrelated to US markets. They structured trades that profited from increased volatility itself. While most investors were trying to pick individual winners and losers, Dalio was betting on the entire structure of the market changing. The timing of these moves is everything. Too early and you miss the real opportunities. Too late and the best deals are gone. The billionaires have learned to recognize the specific moments when maximum opportunity presents itself. It's not at the beginning of a crash when people still have hope. It's not at the end when recovery has already begun. It's in the middle, when despair is complete, when capitulation is total, when everyone who could sell has already sold. This is when assets trade at prices that make no fundamental sense. When profitable companies sell for less than their cash on hand. When real estate trades below replacement cost. When bonds yield more than the companies that issue them can possibly pay. These dislocations don't last long. But when they happen, they create wealth that lasts for generations. The psychological element cannot be overstated. Most people are incapable of buying when everything looks hopeless. Their emotions override their logic. Their fear overwhelms their strategy. They see falling prices and assume further declines are inevitable. They see negative headlines and believe the world is ending. They see other people panicking and join the panic themselves. The billionaires have trained themselves to think differently. They see falling prices and calculate intrinsic values. They see negative headlines and identify overreactions. They see panic and recognize opportunity. This isn't natural. It's learned. It's practiced. It's the result of decades of studying market cycles and understanding human psychology. But it's not just about individual psychology. It's about having systems in place that allow you to act when emotions are running high. The billionaires don't make spur-of-the-moment decisions during crashes. They follow predetermined plans. They have trigger points established in advance. They know exactly what they'll buy, at what prices, with what capital allocation. When the moment arrives, they execute without hesitation. This systematic approach eliminates the emotional component that destroys most investors during market crashes. Instead of making decisions based on fear or greed, they're following strategies developed during calm periods with clear thinking and objective analysis. The chaos of the crash becomes an execution environment rather than a decision-making environment. The results speak for themselves. Every major crash in history has been followed by massive wealth creation for those positioned correctly. The billionaires who execute these three moves don't just preserve their wealth during crashes, they multiply it. They use the forced selling of others to acquire assets that generate returns for decades. They turn financial disasters into generational opportunities. But here's the critical point. These strategies only work if you implement them before the crash happens. Once panic sets in, it's too late. The cash position should already be built. The safe haven assets should already be owned. The investment targets should already be identified. The trigger points should already be established. Preparation is everything. Execution is just following the plan, and right now, in 2025, all the warning signs are flashing. The same patterns that preceded every major crash are visible again. Market valuations at extreme levels, investor sentiment at dangerous highs, credit conditions deteriorating, geopolitical tensions rising. The billionaires can see what's coming. They're already making their moves. The question isn't whether you should follow their lead. The question is whether you can execute these moves with the same discipline and precision that separates the winners from the casualties. Because implementing these strategies requires more than just understanding them. It requires fundamental changes to how most people think about money, risk, and opportunity. Let's start with the brutal reality of move 1, building a massive cash position while markets are soaring. Right now, every financial pundit is telling you cash is worthless. Inflation is eating away at purchasing power. Stocks are generating double-digit returns. Real estate is appreciating faster than ever. Holding cash feels like watching your wealth slowly bleed away. But that's exactly the point. The billionaires are willing to accept short-term opportunity cost for long-term strategic advantage. Here's how you actually do this, not theory. Practical steps. First, calculate your total investable assets, everything except your primary residence and emergency fund. Take 20 to 30% of that number. That's your crash ammunition. Not 5%, not 10%, 20 to 30%. Yes, it feels excessive. Yes, you'll watch other investments outperform while your cash sits idle. Yes, you'll question the decision every single day. Do it anyway. But don't just pile cash in a checking account earning nothing. Structure it strategically. 3-month treasury bills provide safety with some return. High-yield savings accounts offer liquidity with competitive rates. Money market funds give you instant access while preserving capital. Foreign currency deposits protect against dollar weakness. Spread your cash across multiple institutions and currencies. Think like a central bank, not like a retail investor. The psychological challenge is enormous. Every day you hold cash while markets rise, you're losing relative performance. Your friends will mock you. Your financial advisor will question your sanity. Market commentators will call you stupid. Ignore them all. Remember that Warren Buffett was ridiculed for holding cash before 2008. Jesse Livermore was called a fool for building liquidity before 1929. History vindicated their patience. It will vindicate yours. Now move 2. Safe haven diversification. This isn't about buying a gold coin or two. This isn't about adding some bonds to your portfolio. This is about fundamentally restructuring your assets to survive and thrive during financial chaos. The billionaires aren't making token allocations. They're making meaningful bets on assets that behave differently when everything else falls apart. Physical gold should represent 10 to 15% of your portfolio, not gold stocks, not gold ETFs. Physical metal that you can hold, coins and bars stored securely, because when financial systems break down, paper claims become worthless. Only physical assets retain value. The billionaires learned this lesson from studying every currency collapse in history, from Weimar Germany to Zimbabwe to Venezuela. Paper promises fail, physical assets endure. Government bonds provide the second layer of protection, not corporate bonds that can default, not municipal bonds that depend on local tax revenues. Federal government bonds backed by the full faith and credit of the United States. During every crash, investors flee to Treasury securities. Prices rise as yields fall. It's the most reliable trade in financial markets. When everything else is burning, people want the safety of government guarantees. But sophisticated investors go beyond traditional safe havens. They invest in assets that most people never consider. Farmland that produces food regardless of stock market performance, energy infrastructure that generates cash flow in any economic environment, water rights that become more valuable as populations grow, timber that appreciates over decades while providing portfolio diversification. These real assets maintain value when financial assets collapse. The key is geographic diversification as well. Don't keep everything in one country or one currency. Swiss francs have provided stability for generations. Singapore dollars are backed by disciplined monetary policy. Norwegian kroner benefit from energy wealth and fiscal responsibility. Spreading assets across stable currencies protects against domestic policy mistakes. When governments print money to solve their problems, foreign assets provide essential protection. Alternative investments offer the final piece of the puzzle. Private equity funds that buy distressed assets. Real estate investment trusts focused on essential properties. Commodity funds that benefit from supply shortages. Infrastructure debt that pays fixed returns regardless of economic conditions. These investments provide returns uncorrelated to traditional markets. When stocks and bonds fall together, alternatives can rise. The implementation requires patience and discipline. You can't build these positions overnight. Safe haven assets often underperform during bull markets. Gold doesn't pay dividends. Government bonds provide low yields. Alternative investments lack liquidity. But when crashes come, these characteristics become advantages rather than disadvantages. The assets that look boring during good times become lifesavers during bad times. Now the most difficult move, contrarian investing during maximum chaos. This separates the billionaires from everyone else who understands moves 1 and 2 but can't execute move 3. Because when crashes happen, when fear dominates every headline, when friends and family are losing everything, buying feels like insanity. Your brain will scream that you're making a catastrophic mistake. Every instinct will tell you to join the selling rather than oppose it. There you have it. The 3 moves that have separated the winners from the casualties in every crash for the past century. Strategic cash accumulation, safe haven diversification, contrarian positioning, not theories, not speculation. The documented strategies that turned financial disasters into generational wealth. The question now is simple. Will you follow the billionaire playbook, or will you become another casualty when the next crash arrives? The choice is yours.